Hi, I'm Sameer Jain, founder of Active Allocator. Let me take a stab at addressing the complexities of investing in alternative investments. Having looked at asset allocation systems and methods in the most sophisticated of firms, I find that practitioners are at a loss on how to properly allocate to illiquid and alternative investments. So we are all very familiar with traditional investing in stocks, bonds, and cash, as well as how to allocate to them. Alternative investments are a different ball game because they come in many flavors. In real estate, we have core, value add, opportunistic funds, CMBS, non-traded REITs. PE itself has many sub-flavors such as VC, buyouts, mezzanine, special situations, distressed investing, each with its very unique asset characteristics. And hedge funds invest in equity and fixed income markets. They employ sophisticated trading strategies. They may use leverage. They can short. They often use derivative instruments. And there are over 20 different strategies in this space alone. So this is a pretty wide swath. It is important to make sense of this and provide appropriate exposures in changing market regimes to clients. But where it gets tricky is alternative investments are not required to register under the Investment Company Act of 1940. They are not listed on an exchange. They are offered as private investment funds, and many have an absolute performance objective. They typically also exhibit reduced liquidity relative to traditional investments with monthly to multi-year lockups. Their managers typically charge higher fees, which may include a performance fee. And then there is also a very large dispersion of performance across managers and a degree of performance persistence. Therefore, even more so than for traditional investing, manager selection is extremely important. So conceptually, we need a new framework, a new lens to look at sources of returns within AI. And traditional passive investing is all about beta, which is exposure to a bunch of fundamental market factors, exposure to non-diversifiable market risk. If the economy is improving, if corporate earnings are growing, just buy an ETF or to hold the S&P 500 cheaply. If interest rates are expected to fall, one can just buy bonds. So this is very commoditized business, and to increase returns, you need to take a lot more risk. Active management, however, is about skills-based investing. It's about which stock to buy, how much, or which property to buy, asset selection skill, when to buy, when to sell, the ability to participate in inefficient markets through access to deals and sourcing. This is the realm of active investing and is an integral part of, should be an integral part of portfolios, according to me. At Active Allocator, we believe that alternative investments within portfolios can be a good servant but a bad master. And from what I see, almost nobody seems to be doing asset allocation correctly. And most folks simply extend traditional frameworks to alts, which in my view is improper. We cannot use traditional Markowitz mean variance optimization as their returns, the return series, are non-normally distributed. They have skewness and kurtosis. Also, return series can be misinterpreted unless one accounts for an illiquidity premium. Also, tradability and redemption restrictions limits rebalancing opportunities, as well as it introduces costs of lost opportunity. And since this is a private industry, returns are self-reported, which sometimes creates an upward bias in indices. Moreover, we don't have too much control of what a manager does after we give them our money, and managers can and they do dynamically change strategies. So one needs to account for strategy drifts to create rational strategy groups. So we at Active Allocator, unlike others, explicitly account for these and other unique data biases, and we employ techniques to create a more robust allocation framework. I encourage you to take a test drive on our system or just get in touch with me. Thanks so much for listening in. Bye-bye.